When you need financial guidance, call Brokers Alliance.
Well, welcome back to the Quest for Financial Freedom. I'm your host, Steve Savant, and of course with me today is national insurance expert Eric Palmer. Eric, you can have us, well, you can write Eric right at the same address, thequest@brokersalliance.com, or call him at 1-800-290-7226. That's 1-800-290-7226. In the second segment of today's show, we're going to continue talking about, I can't believe it, the government's going to give us something. Well, here we are talking about, after I told you how much the government, we owe $14.1 trillion, right? Now the government is going to start helping us. There are deductibility issues now for LTC, whether it's owned by the employer or even people can take off different, even aspects that we're going to be talking about all this week, even linked benefits, LTC benefits. There are some tax deductions to be had, but not as big as the one we're going to talk about right now. And if you are an annuity holder in the United States, and this has got to be huge, and I can't believe they gave this to us. If you have gain in any annuity, now it could be market value.
Right.
It could be guaranteed rate.
That's right.
It could be indexed. We don't care what it is. It could be variable, although maybe not after the last 2 years, But whatever your gain in annuity, if you have a gain in your annuity, the government allows you to transfer it under a section code called 1035. Under the section of 1035, you can exchange your annuity with gain for a compliant 2006 Pension Protection Act annuity that has an LTC linked benefit. Now, be advised, there's only 4 or 5 carriers in the entire United States that are compliant. Everybody hasn't gotten on board yet.
That's right.
So when you exchange your annuity with gain, and then you use your annuity for long-term care benefits, you pay no tax.
That's right.
I mean, Eric, I've died and gone to heaven.
Prior to January 1st of 2010, we didn't have this rule in force. So before, when we would exchange an annuity contract using a 1035 exchange to fund a long-term care vehicle, we were paying taxes on the gains in those contracts, and that eats away at the dollar. That buys less long-term care. So obviously the advantage is putting more money to work in these policies. January 1st, 2010, the Pension Protection Act of 2006 was put into effect in regard to 1035s on annuity contracts, and now the distribution and the actual 1035 transaction itself totally tax-free.
What's amazing about this is prior to the act, we were using annuities, and we had to pay the tax on the gain because after 1982, we switched from last in, first out. In other words, whatever gain you had in your contract,
that's right,
you went to surrender part of that to pay for your long-term care, your medical needs, but that was a taxable event. You had to pay your taxes, and then the net proceeds could be used. Now the government's saying if you have gain in the contract and you exchange it under this 1035, then you're allowed to go ahead and use that money, and as you're spending down through your long-term care, you're not paying any taxes on that gain.
Absolutely. And again, more dollars go into the actual long-term care policy, creates a larger benefit, puts your money to work a little bit better than it did before.
But another cool thing, we're going to get into this down the road here at about Thursday's show, I think it is, when we're scheduled to talk about this. But one cool thing that I really like about this LTC with an annuity, this LTC linked into an annuity contract, is what if I don't become one of the 70% we talked about in the first segment? What if I'm one of the 30% of the guys? What if I'm Jack LaLanne? The guy just died at 96, Mr. Physical Workout, PT trainer, black and white television in the 50s, right? The guy just died a couple weeks ago. And Jack LaLanne, can I say this on the air? He was a stud. I mean, this guy was fantastic.
And was it a health-related?
He caught pneumonia.
Yeah.
It wasn't because Jack was not in shape. I mean, that guy looked great. But Jack, I mean, he was 30% of the people that didn't go to a nursing home.
Right. Well, one of the big deterrents from purchasing a standalone long-term care, we talked about it kind of at the beginning of today's show, is not just the cost, but it's also that use it or lose it type mentality. And folks are afraid that if you tuck a lot of premium into a policy and you don't end up using it, you're going to lose all those dollars. So the annuity gives you the advantage where you can actually invest your money, earn an interest rate, and if you don't use it, it passes on using a typical structure of an annuity where your beneficiary inherits the lump sum of the account value with any potential gains that were in it at that time.
Now remember, ladies and gentlemen, you want to check with your tax advisor or your CPA, whoever your person is advising you on taxes, to what deductibility issues, because some of these linked benefits are into life insurance, they're linked to annuities, they're standalone long-term care contracts. Even the disability that we're going to talk about tomorrow has some deductions if the company owns it. There's a lot of cool things to look into.
That's right.
Please explore the tax advantages that you may or may not be able to take access to. It's very important because it's not only, this is a tremendous leverage to have your gain in an annuity contract not taxed. I mean,
right.
this is going to blow out any municipal bond income scenario that I know of. I mean, I have to look at the numbers, but always ask your tax advisor, because if you're an owner, an employer, there's some sweet tax deductions. If you're an individual, there's some sweet deductions for LTC portions of these contracts. And of course, again, when we get into things like looking at the net outlay when we take these deductions, I mean, this is now becoming affordable.
Absolutely.
So what Eric, we're going to be talking about all these things all week, and it's not that we're down on regular full contracts, full long-term care contracts. You just got to remember what you're getting into here. And some people say, listen, I think it's a crapshoot. I may or may not use it. Then if that person feels that way, they got family history that tells me, hey, these people have lived a long time. A lot of people didn't go into the nursing home in their family. They've been kind of a stout generation.
Right.
Well, I may say, no, let's not use our regular long-term care contract, because as you said, if you did buy that standalone, then you would have a use it or lose it principle. If you didn't use it, right? You lost all your premiums.
And there's some smaller nuances to these policies, and we'll talk about that, I think, later in the week, too, on the standalone. But, at the end of the day, we definitely support the standalone long-term care. It's a robust long-term care policy. But today, what's on the consumer's mind, what's on my mind is affordability. Can I afford this policy? Do I have the extra cash flow to provide this type of coverage for myself? And these cross-linked products, these annuities with the built-in long-term care or life with built-in long-term care, they provide a little bit more affordable approach to insuring yourself.
Now, when we talk about long-term care, Eric, I keep hearing this activities daily living, this ADL phrase.
Right.
Well, what is ADL?
Well, there's a chronic illness feature that we find in these policies, and chronic illness is essentially, determined by your inability to perform 2 out of 6 major acts of daily living. And an activity of daily living is dressing, feeding.
You mean dressing yourself?
Dressing yourself, exactly. Feeding yourself. Very simple things that a long-term care event could prevent you from being able to do on your own.
So let's say I'm looking at these 6. You can feed yourself, you're golden.
Right.
If you can bathe yourself, sweet. Actually, real sweet, because I'm not really interested in somebody bathing me, but dressing yourself, okay? Toileting. Now, I love that phrase. Isn't that nice and civil? Toileting. I guess you can get on and off the toilet, right? I'm assuming. I'm just going down this list.
Right.
And you're maintaining continence. And you are transferring. You have the ability to be mobile. Even if you used a wheelchair, you can get your wheelchair out of the van. You just need to qualify for how many of these 6?
2.
And is that pretty standard across the industry?
That seems to be 99% of the time what we're looking for is 2 out of 6 activities of daily living.
Okay, so activities of daily living, if you hear that initial or that acronym, it's ADL. Actually, it's not an acronym, but ADL. So we're looking at 2 of the 6. If you do 2 of the 6, and later on in the week, there's going to be some really good contracts. If you can, and a lot of these people, how do they qualify? Do they go over the phone? Do they take an exam?
There's a variety of different ways to qualify for these policies, but some of the cross-links, like the annuities we're talking about, it's a small application, a simple 20-minute telephone interview, and then they do things like a prescription check, where we're looking at the last 10 years history of your prescriptions that you filled to make sure that it matches up the information on the application.
But no blood, no urine.
No blood, no urine. We call it a simplied issue.
Are they going to go to your doctor for attending physician statements?
It's possible. Some standalone policies will look at that, but we have a variety of different ones to choose from.
As we're tying up this segment, I noticed, though, that some long-term care carriers have just raised their rates. So I'm kind of cautious now because of that occurring, it's starting to wake me up that, hey, listen, did they price this product enough? And, by the way, included what we said in the first segment, which is, did they price in the longevity issues of being in there? Because we're talking usually 4 or 5 years in a long-term care facility or hospice or at home.
I think it's important to note that a premium increase, although we don't like them, we don't want to see the premiums increase, it's not necessarily a negative thing. It's an adjustment these insurance companies are doing because as more and more people are starting to enter into that phase needing long-term care, they're finding that they're going to have to make some adjustments to premiums. There's more people and more individuals living longer and needing these types of benefits, and the cost is going to go up a little bit over time.
Well, the baby boom generation, we are going to be the largest demographic to hit retirement. We are going to affect everything, including, by the way, this long-term care issue. And if there's more of us there, maybe we can spread the risk across the board on our population.
I'll throw one more statistic out there because it's interesting. You mentioned baby boomers. First baby boomer retired a couple of years ago, so we're in our mid-60s generally with that population and growing. So over the next 20 years, you're going to find a lot of activity from that group in the long-term care realm. 97% of individuals over the age of 85 require some form of assisted care, and it may be minute or it may be widespread, but that's a staggering statistic. So if you are a baby boomer and you're listening to the show today, start looking at long-term care if you don't have it now, because now's the best chance to get it at the most affordable premium.
Or become like Jack LaLanne and start working out 2 hours a day, 6 days a week.
That's right.
Because if you don't want to be sitting there, what was that percentage after 85?
97%.
97%. Man, I'm just going to start watching Jack LaLanne videos. I'm going to get myself up for this. You know, I don't want to be sitting there having to worry about this. But it's good insurance, and it's really good because you don't want to really tax your family with this issue. I mean, the baby boomers, we have already experienced taking care of our kids and taking care of our parents. We didn't think the World War II veterans and the Korean veteran were going to live this long.
Right.
We just didn't expect longevity like this. I mean, you think the 2008 value-based tables from the Society of Actuaries came out only 3 years ago. You should see the numbers they're talking about. I mean, my dear wife, who I've been married to for 36 years, I mean, this gal is going to see 100. I mean, I just looked at her stats. I've done all the questionnaires on the web. They have a really fantastic mortality. We have it on our website, too. You can check out how long you're going to live. And I think these gals are going to see, and the baby, a lot of these girls are going to see age 100, period. They're just going to see it.
There's some of these policies out there, too. They do provide joint ownership and joint benefits. Sometimes they even provide spousal discounts. So I think it's important. You brought up the wife and the husband scenario. You know, women are showing to live longer than men, and it's important to look at both options.
Well, we got to go, but remember,